there's all different scenarios when it comes to replacing a policy. Remember, when you're there, commission should not be the first thing on your mind. It should always be taking care of the client, doing the right thing. And granted, we're all commission driven, so I'm not going to sit and tell you it's not commission. Yet, you've got to do the right thing, because I believe in doing the right thing, and I do believe in karma. You're going to go to somebody's house, and you're going to be speaking to them about life insurance, and they're going to sit and tell you, Joe, I've got an insurance policy that I've had for a long time, and I need more insurance, but yet I really can't afford much more. So, as always, you ask them, do you have another policy in place? Yes, I do. May I see it? May I look at it? So you're going to look and see if they have those three columns: cash value, paid up, and extended term. Example number one. Let's say the person is a little bit ill. They had a heart attack, they had a stroke, they've got cancer. Things are not looking good for them. Their doctor told them, you may have 2 years to live. Now granted, doctors, it says Dr. So-and-so, but it doesn't say G-O-D. The doctor's going by past knowledge, things he's talked about, past clients. So it's literally impossible for a doctor to say you only have X amount of months. They're guessing. So if somebody was to tell me the doctor told them they had 2 years or 1 year, I'm going to double it and maybe add a little bit more just for my peace of mind for that person. Because once you put these in one of those categories, you can't go back 6 months from then and say, oops, I made a mistake. Can I revert back to the original one? Doesn't work that way. You got somebody that's not in good health. They got some type of cancer and it's not looking good. Yet they're insisting on buying more. With an additional paid up column, every month you make a payment which makes your cash value grow. It makes every one of those three columns get higher. And what I mean by higher, the cash value grows accordingly. Most cash values start, some of them start the middle to the end of the first year, depending on what your premiums are and the face amount. The paid up additions, which means that if you decide to use that column, it's going to grow every single month, every year you're going to see. And whenever you look at those numbers on the schedule page, it's called the table of guaranteed values. I got a cheat sheet here. It's going to show you whatever number you see is at the end of that year. So if you see year 2, let's say it's $1,000, and year 3 is $3,000, in between is going to be some number kind of in between. You need to call the company to find that out. So let's sit and say the person says, I cannot afford to buy, I want to buy more insurance, yet I can't afford to have both. Go down that list and say, okay, here are your options. You can do a reduced paid up policy. So if they got a policy, let's say for $15,000, you're going to go down, let's say it happened to be the end of the 8th year. It's going to go $3,250. Whatever that magic number is, you can tell them you can stop making payments on this one here and get $3,250. Okay, I don't think that's the smartest thing to do. Or you can go to the extended term column. The extended term is some calculation that they use based on the cash value, based on a pre-designed premium for that. They divide that premium into the cash value, and it's going to come out and say you've got 7 years and 72 days, or you've got 9 years and 147 days. It's going to tell you that there. So, if I got a client who is not doing well, their health is not doing good, they want more insurance, okay? And the only thing you can get him is a guaranteed issue, and he's willing to do that, okay? You can stop the payment on his current policy. Premiums are going to be less than what they're going to be now. Stop those premium payments, and if he's got 7 years and 19 days, you're going to say, listen, you got 7 years and 19 days. of full coverage, the full 15,000. And if you want, we can exercise that option, and we can start you another policy for $5,000. And if something was to happen to you in the first 2 years, your beneficiary, Maria, is going to get all the money back you put into it, plus interest if God forbid you pass away in the first 2 years. After 2 years, she's going to get the full $5,000. Or if you're on the way to the doctor, somebody runs a stoplight and you pass away accidentally, a slip and fall, whatever, she'll get the full $5,000 day one. Okay? Some people like that idea. Some people say, you know, I kind of need that $3,000 of cash value now. Jack Skaggs and I went down to Delray Beach. God, it seemed like 50 years ago, probably about 10 years ago, ran a bunch of leads, had a lady that had a policy. We did a cash in because that's what she wanted to do, okay? She wanted to do it. So we got her, I think it was probably right around $3,000. And we started her another policy. A little bit of a smaller face amount, yet the same premiums. So she was happy. And the only way you're going to get close to the same premiums is as you have a company today that's very inexpensive, and they happen to have bought a carrier years ago that was very expensive. They have carriers like that now. Some are here, our competition, and we're down here. So never forget that. We always have competition that's higher than us, and believe it or not, we got some that are lower than us. Okay? The lower the premiums, the harder the underwriting, the harder it is to get it. Cash value is usually what people want. In the cash value, that's also used for if the client misses a monthly premium, the company will automatically borrow the money for their premium out of their cash value to keep the policy going. Now, whenever the company borrows money from the cash value, okay, they're going to be charged a little bit of interest on the money that they borrow. Client's going to make interest on it. When the money comes out, they're going to pay a little bit of a premium, probably like about a 2% premium of what they're going to pay on that borrowed amount. If the client borrows, let's say the client's got a $15,000 policy, and they get 5 payments of $100 a month, okay, that's $500. The client passes away before any payments or some of the payments are made. What the company's going to do is that they're going to get the face amount, subtract the amount that was borrowed, plus any interest that accrued, and subtract that from the face amount, and the beneficiary is going to get the difference. Face amount minus what was borrowed, minus any accrued interest that was there. Those two added together, subtract from the face, and the client's beneficiary is going to get that magical number. Our job is to do the right thing. Our job is to help these people out. We're the professionals. We're the ones that are going to go there and guide these people to make sure they've got peace of mind. There's some agents out there, guys, that are not like me, not like you. They just out there to try to make a fast dollar. They don't care about the 2-year contestability. They may go gray, okay? You need to be careful because you got a family that is depending on your expertise to advise them what is smart to do for their loved one that you're there talking to. Person has cancer. Person's got something very wrong with them, okay? And they want to exercise one of those there. You've got to take a step backwards and say, well, if I don't do it, somebody else is going to do it. You need to tell the people the pros and the cons, and then from there, they make the choice. Now, let's say it happens. You do it. I'm going to recommend you to have the client sign a piece of paper. I, Frankie Jones, on October 14th, 2024, had Joe Ciaccio, my insurance agent, come to my house. He explained to me what I was doing, and to understand that if I borrowed this money or if I put it with a paid up or an extended term, and when that period runs out Either I'm going to have less coverage on the paid up, or I'm going to have only coverage on the extended term for so long. I do understand this here, okay? Have them sign it, date it. If they got somebody there, put witness and have them sign it. So somebody, beneficiary, doesn't come back and say, you bamboozled my grandmother, you screwed my father, and you took advantage of him. So hold on. I got a piece of paper right here that he knew exactly what I was doing, okay? Now, granted, they may say, well, he was senile, he had Alzheimer's, all that stuff there. If you feel that person is in sound mind, if you want to go deep, I'm in sound mind, all that stuff there, you just want to get that person to put their name on there, that you advised them, you told them the good, the bad, and it was their choice, okay? Now, I got a policy here that this is for a 66-year-old male, okay? And this is from American Home Life. I got this one from. 66-year-old male, $10,000. He's got COPD. He got their standard rate. His rate is $139 a month. At the end of the 10th year, so when he'll be turned 76, he'll have $2,600 of cash value. He'll have paid up insurance of $3,600, and he'll have 5 years and 5 days of extended term. He's 76 years old. You go visit him. He's got something very wrong with him. He's going into a nursing home. The old guy's not doing too well, and he insists on doing something. Okay? He insists. And you feel that it's necessary, you feel that it's okay, in your heart and soul you feel you're doing the right thing, and you put him on the extended term. He's going to have 5 years and 5 days to still have this $10,000 policy, makes no more payments, and he can use that $139 to buy a guaranteed issue policy, let's say for $3,000, $4,000, $5,000, whatever he feels he can afford, or whatever he feels he needs. When you're in this situation and you're unsure on how to handle it, gather the information, take a picture of this page here. It's got cash value, paid up, extended term, and the years over here. Take a picture. Send it to me. I'll be happy to review it with you and talk to them or talk to you. Don't have me on speakerphone. We'll sit and talk about it, and then from there you talk about it with your client, okay? Smooth sailings, guys. You got any questions, call me. Medicare knocking on the door on the 15th. If you guys got it, you got to get out there and start hustling to make some money. If you don't have it, get with Jay. We'll get you set up to where you can get out there and start cranking it towards AEP, and then get ready for OEP that starts January. We love you. We appreciate you. Be safe out there, guys. Bye-bye.